If you've ever felt like investing is just too risky or too confusing or just not worth the hassle, you're not alone. That's why most people hand their money to someone else or just throw it in a company-directed 401k account and completely forget about it. But there's a problem with that. This approach can cost you tens of thousands of dollars or more over the long haul, and in many cases, you'll never get the level of wealth that you actually want. So if you want to grow long-term wealth, you've got to think differently about investing, and in this video here, I'll explain why. So let's kick things off with a question you might not hear often enough, which is why do so many people hand over their investment decisions to someone else? Well, if you've ever felt a little lost when it comes to investing, you're definitely not alone. In fact, the majority of Americans say that they don't feel confident managing their own investments, and that's a big reason that they turn to, financial advisors, robo-advisors, or even friends for advice.
According to MoneyWise, 45% of Americans feel confident managing investments, while 55% remain uncertain about their financial decisions.
Exactly. It's a common problem. But think about it. Investing can feel like learning a new language, right? There's a ton of jargon, endless choices, and let's be real, the stakes feel high when your hard-earned money is on the line. And for a lot of folks, the fear of making a mistake is enough to push them into the arms of a professional, even if that means paying extra fees or, not really understanding what's happening with their money. Or even worse, people don't invest at all because they're simply too scared to lose their money. But it's not just about fear. Time is a huge factor too. So most people in their 20s, 30s, 40s, they're juggling careers, families, and maybe even side hustles. So sitting down to research stocks or learn about ETFs, that usually falls at the bottom of the to-do list. But here's the thing though, relying on others might seem like the safe route. I understand it, but it will keep you from reaching your full wealth potential. And at the end of the day, you need to take control of your investments because you care more about your financial future than anyone else ever will. That said, have you ever wondered what it would look like to be fully in charge of your own investment journey? Because that's what we're going to dive into here next. So self-directed investing is exactly what it sounds like. You're the one calling the shots. Instead of handing your money over to a financial advisor or just, letting a robo-advisor pick your portfolio, you're the one choosing where your dollars go. So whether that's, stocks, ETFs, real estate, or even alternative options like crypto.
Think of it like building your own meal at a buffet. You pick what fits your appetite, not what someone else throws on your plate.
Great point, Tiara. Definitely true. Now, before you picture yourself glued to a screen, day trading like you're in some Wall Street movie, I want to clear something up here. So self-directed investing doesn't mean that you have to be, a financial genius or spend hours every day analyzing charts. It just means that you're actively involved in the decisions that shape your financial future. But as you might guess, with more control comes more responsibility. And that's where the real benefits start to actually show up, which is exactly what we're going to dive into here next. So let's start with flexibility. So when you're calling the shots, you're not boxed into someone else's, one-size-fits-all strategy. If you want to invest in a hot new tech stock, diversify with real estate, or even try out alternative investments, crypto, anything really, your portfolio can actually reflect your interests, your risk tolerance, and your long-term goals, not just what someone else thinks is best for you. Plus, any money manager has fees. So let's talk about how much those can actually eat into your returns. So did you know that the average financial advisor fee in the US is about 1% of the assets that you have under management per year? Now that might not sound like much, but over 30 years, it can add up to hundreds of thousands of dollars lost to fees, which is money that could have been invested and compounded instead. When you invest on your own, you can cut out a lot of those ongoing costs. And that means more of your money stays invested and working for you. But the real game changer is control. When you're the one making decisions, you're not left wondering what's happening with your money. You actually understand your investments and you can make changes when your life or the market, shifts. So if you want to rebalance because, you're getting closer to retirement, no problem, right? You could take care of it in a couple of hours on a Friday, right? Instead of waiting days or sometimes weeks to speak to someone else about it. So here's a quick example. So imagine that you're invested in a target date fund through an advisor, like a you're going to retire in 2050, so that's what the fund target is, right? But you notice tech stocks are dipping and you want to buy more while prices are low. Well, if you're self-directed, you can make that move instantly. If you're relying on someone else, you might miss the window. Of course, all this freedom, it comes with a catch though, right? So taking control, it means that you're also responsible for the outcomes, which are good and bad. So what are the challenges that you need to look out for? Well, we're going to unpack that here in the next section. And trust me, knowing these pitfalls, it can make all the difference in your journey. So if you're thinking about taking control of your own investments and ditching the middleman, right? It sounds great, right? But here's the part that most people don't talk about. Going solo, it obviously isn't all upside, and some things can really trip you up. So let's start with the most obvious one, which is responsibility. When you're managing your own portfolio, every decision falls on you. There's no advisor double checking, the different moves that you're making or catching mistakes before they happen. And that can feel a little bit intimidating, especially when the market gets rocky. And if you've ever felt that, pit in your stomach after a stock that you picked, just takes a nosedive, you know what I'm talking about. And then there's the research. It's not just about picking a few stocks and, hoping for the best. Smart investing means understanding what you're buying, staying up to date on market news, and knowing when it's time to, make a move or when it's better to just kind of sit tight. That takes time and effort, and you probably already have a lot on your plate. So if you want help figuring out, the right investments at the right times without having to spend hours buried in research, make sure that you subscribe to the channel. That's exactly what I focus on here. In fact, in the next video, I'm going to break down the one monthly dividend stock I'd buy above all others and explain exactly why it stands out right now. Now, another big challenge is emotional decision making. This is a huge one with investors. So when your own money is on the line, it's easy to completely panic during a downturn or get greedy when things are going well. Studies show that the average investor tends to underperform the market, often because of emotional decisions, right? Like selling, selling low during a crash or chasing hot stocks at the peak. It's super common to do, right? And that's a tough pill to swallow, but it's a real risk when you're going solo.
Remember how everyone wanted to buy GameStop after it hit the news? Classic example of FOMO investing gone wrong.
Exactly. And some people, they made money, but a ton of people lost a ton of money. And don't forget about information overload either. With so many voices online, some legit and some not so much, it can be tough to figure out who to trust. So, one day you're reading a blog post about the next big thing, and then the next day you're watching a YouTube video warning you to stay away from that thing. But here's the good news. These challenges, they aren't deal breakers. In fact, just being aware of them puts you ahead of most people. If you're willing to put in a little work, learn from your mistakes, and keep your emotions in check, you can absolutely succeed as a self-directed investor. So if you're ready to see how to actually get started and avoid a lot of the rookie mistakes that kind of trip people up, especially the beginning investors, stick around because that's what we're going to break into here next. So getting started with self-directed investing is just way more straightforward than most people think, right? First, you'll need to open a brokerage account. So you can think of that as kind of your personal gateway to the world of stocks, ETFs, and other investments. And these days, setting up an account, it's very simple to do. Most online brokerages, they don't charge account opening fees, and many of them actually offer commission-free trading, so you're not losing money right out of the gate. Now, if you're looking for a place to start, I would recommend that you go ahead and click right up here and get to Robinhood, which is a very popular, app for beginners and has plenty of educational resources for investors built in. And once your account is set up, it's time to figure out your goals. So are you investing for retirement? Are you saving for a house? Or just, trying to grow your wealth over time? Your goals will shape everything from the types of investments that you pick to how much risk you're actually willing to take on. And now let's talk about actually picking the investments, right? This is where most people freeze up, but you really don't have to overcomplicate it. I'm gonna make it super simple. So start with the basics, which is broad market index funds or ETFs. So these are baskets of stocks that track a whole market or sector, so you get instant diversification without needing to pick individual, stock winners or losers. Two that I love, VTI, which is the Vanguard Total Stock Market ETF. And the other one that I like a lot is VOO, which is the Vanguard S&P 500 ETF. Both of these have very low fees, are very well diversified, and it's basically exactly what you want. Just keeps it simple. And here's a pro tip from someone who's been doing this for a while. So automate your investing. Robinhood lets you set up automatic contributions from your bank account so that you're consistently investing without having to really think about it. And this strategy, which is called dollar cost averaging, it helps, really smooth out the ups and downs of the market and make sure that you keep building wealth over time. Just don't turn it off, never withdraw money, even when the market takes the inevitable downturn. That's key. Even $50 or $100 a month, that can really add up big time over the years. So just set it and forget it pretty much. Okay, so now that you got the tools to start investing on your own, you kind of understand it, right? I don't want you to just start dumping money in and investing like crazy. Instead, let's make sure that you don't fall into the traps that catch so many beginners. So in this video right here, I'll walk you through the 7 most common mistakes that every stock market beginner tends to make and how you can avoid them from day one.